In this video, traders, we're going to look at what is the best time frame for both swing trading and day trading. Stay tuned. Hey traders, and one welcome to you. Okay, so we're answering the age-old question of what is the best time frame for both swing trading and day trading. I'm going to give you my opinion, the time frame that I specifically use for day trading, for swing trading, and I'm also going to give you the time frames that I know other traders use who are successful in currency trading in particular, and I also got another guy who I know trades very well in equities. I'll tell you the time frame he uses as well. Okay, so we've got a decision to make, right? If we're looking at time frames, obviously the higher out we go, we're getting way more time, but we're getting much less information about what's happened frequently. So, or recently, should I say. So a 1 month is every candlestick represents a month. A 1 minute, every candlestick represents a minute. And we've got tick, which we'll come to in a second. Let's just put that, make sure it's clear. It's 100 tick. So we'll come to that in a second. Right. So one thing, one caveat to say, guys, is that we always want to make sure that we know what the higher time frame is doing. So specifically if we're day trading, we want to make sure that we at least know what's going on a higher time frame. So whilst we're definitely not making our trigger decisions based on any daily, weekly or monthly time frame, we do have to glance at that. But with day trading, once we've done that, we shouldn't have to glance at that again for maybe another week because we're so actively involved in it every day, potentially that trade. So from a day trading perspective, I think the combination that I personally like is this. So I'm always going to look at the 1 day first. I need to see the daily just because everyone's looking at the daily. I think regardless whether you're swing trading or day trading, you've got to look at the daily. Now, do I have that up on my screens when I'm executing? No, I don't. I don't need to, but I definitely want to see where the trend is. I want to see where the big key levels are, key support, key resistance, fresh highs, what's happened after earnings, if it's a stock, what's happened, you know, all the stuff that I need to do. That's what I'm basing my initial theory on. I want to see that I'm aligning myself potentially with the trend or if it's a reversal, etc. So 1 day. Now, for me, this is where I pivot things a little bit. I will switch between a 15-minute and a 60-minute depending on what's happened. So if I prefer to use a 15-minute purely because I'm going to get a lot more information in the chart that I need. So I can get 3 or 4 days in, depending on what size screen you've got and how you're formatted. I can get 3 or 4 days in on a 15-minute chart, obviously depending on whether I'm trading a 24-hour currency pair or I'm trading a stock. A little bit of variation there, but I feel like I can see more what's happened intraday with a 15 minutes. A little bit more detail that I like, because I like that detail. But if I feel that, you know, that's not giving me what I need to see, perhaps we've kind of come up in a different area, I'll flick to the hourly, the 60-minute, just to see kind of what we are on longer, get more days in there so I can see what's happened. Now, most of the time, you're going to find that that's maybe irrelevant. Now, especially if I'm in a short-term mode where I'm being very aggressive, I'm looking to kind of take stuff out within an hour type of trade, then the 60 minutes less important to me because I'm looking where it's going to go over a 4 candle period in my 15-minute, and I've probably got everything I need in my 15-minute. If I'm kind of waiting for something different, then I'll go back to a 60. So I oscillate between those two. Now, the danger is, guys, is that you try and have too many time frames in. I've made this mistake myself. Like, for example, trying to have the 15 and the 60, just pick one. You know, if you find the 60 is too much, it's not giving enough detail, go for a 15 and vice versa. Or maybe split the difference and go for a 30. Don't know why I don't go for a 30, but for me, it's kind of habit as well. 15-minute feels comfortable. I feel like I've got the information I need from that. Okay, so daily, 15-minute, 60 if I don't feel I can get what I need from the 15, but generally 15-minute. Then, this is where it gets a bit strange for me. I like to look at the 5-minute because I feel that on an intraday, now these two are interchangeable for me, the 3 and 5 minute. I like to see what's happened over a 2-day period or a 1-day period all in one screen. So the 3-minute, the 5-minute, that normally gives me a couple of days that I can get a good clarity of what's happened yesterday. Sometimes I might be able to fit in the 3rd day, depending on where we are, if at the beginning of the day I've just started or whatever, but I can get a bit more clarity and see, okay, there's the levels, that's more important, right, okay. And specifically, I do have some setups that do utilize a 3-minute chart specifically. That's an odd time frame to use, and that's probably when you saw this, you were like, well, 3-minute, who uses a 3-minute? But only because generally I have some setups for that. So I will default to the 5, and if I want to go to 3, I'll go to 3. So my default is going to be the 1 day, the 15-minute, the 5-minute, and then the 1 minute comes in when I'm pulling the trigger. It's specifically for day trading. Do you know what? Even if I'm swing trading, I'm going to look at that 1 minute just purely because it's habit. I like to see what's happening now. Can you get sucked into seeing that and looking at this small picture right under a microscope? Of course you can, and that's a dangerous thing to be. But if you've already made your decision, you've already done your filtering and you're ready to pull the trigger and you just want to see something specific, then I'll use a 1 minute on execution. Now, that is to say that if I have, let's say I'm looking for a specific price action candlestick pattern on the 5, then I'll have the 1 minute up just to finite and know where I am, but the trigger will be made on the 5. And I'll have the 1 minute up just for kind of a bit of a crutch, really, to be honest with you. But anyway, that's really what we're looking at. 1 day, 15, 5, and 1. Now, that fits very nicely because you've got 1, 2, 3, 4. If you've got just a big screen, you can obviously split up into 4 quite easily. Very easy to make a decision. Or you can often have 4 up, and then what I used to have my main screen. Well, actually, now I've got far less screens than I used to. I used to be running like 8, 9, 10 screens, ridiculous, but now you can split your charts up and the resolution's so much higher, so you can have 4 charts that you can easily see what's going on one screen, and then maybe your other screen is your execution. Maybe you have a big 1 minute on that, or however you like to mix the flavor. But back to the initial point, best time frame, a chart time frame for day trading, for me, 1 day, 5, 15, 60, and then the 1 minute in for execution. And as I say, with daily we don't need to have up all the time, but it's something we'll check. Right, I know a very good currency trader who swears by the 240 minute. For whatever reason, that's the time frame he likes to trade. Now, he holds trades for a lot longer, and he will look on in fact, he will kind of ratchet things up completely. He's not a very aggressive day trader, like I say, more of a swing trader. He will look at the weekly, the monthly, the daily, and the 240. He doesn't get involved in anything up here. Now, that works well for him, and you've kind of got to work out what works for you. Swing trading for me, I still like to look at the daily, and to be honest with you guys, I still like to look at the 60 and the 15. And then really, I sometimes bring the 5 up as well to pull my trade, even though I've made my theory on where I think it's going based on the higher time frames. I'm still at that 5 minute up because I want to see that granular action. I want to see right into what's going on before I pull the trigger, even if I've got a thesis of a 4 or 5 day move. And by the way, swing trading for me is that, very rare will I hold something for a couple of months. So that's the time frames. Now, would I go back out to a month? Hardly ever. If someone might highlight it to me and say, "I'll look at the monthly," and I'll like, okay, I don't know. I'll honestly say I haven't looked at the monthly on that chart. I'm quite happy using the daily, the 60, 15, 5, and then just getting rid of obviously the lower time frames. Now, if you're an extra aggressive scalper / day trader, then moving to tick charts can help. Now, there's a bit of a caveat to this, is that this is if this is your thing, then this is your thing. If it's not, I don't suggest that you start going down the route of scalping aggressively using this, because it just adds a heck of a lot of noise. However, when you're using these tick charts, and even dare I say a 1 tick chart, now this people are probably going to go, "What are you talking about?" But when you are very, very, very carefully trying to time something, like if you're a subscriber, if you're watching my videos, this kind of pattern is my favorite, the flag pattern. By the way, I appreciate your subscription. If you are a subscriber, thanks for the support, guys. I will really want to time this thing. And so a tick chart will look so noisy, like you're literally moving every tick, so it will just look ridiculous. But perhaps you want to wait until you see a slight couple of ticks back before you jump on. Let's say you want to get on, you're ready to get on, you're ready to buy a break, for example. Okay, you don't want to wait for a 1 minute pullback. You want to buy the break in this 1 minute candle. And so you might want to go down to 1 tick, a 50 tick, whatever tick level it is, to see kind of a bang, 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 bang down in red, and then you're hitting long as you get the first green. So it's really going excessively trying to fine tune stuff. And for the majority of people, there's no need to do that. And in fact, if you had a choice, I don't think you'd even bother doing that. And do I do that very often? Very, very rarely. But it's there, it's something to do if you're trying to finesse something really, really an accurate level. Do I think really it helps that much? Probably not. Could you do the same thing on a 1 minute chart or using the tape? Yes, you probably could. As the candlestick's coming up, as it's starting to rock back a bit, you could use that. But for me, this visual appearance of like green, 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 and then a few reds that just pause. And actually, one thing, guys, you can very often see support on the order book on a tick chart, because it won't go lower than that, and you can suggest or insinuate, should I say, that actually there's a big order stacked on the order book there. So recap: day trading, 1 day, daily 1 day candle, 60-minute 15.51, or I'm interchanging the two, but I prefer the 1 day 15.51 in reality. And for swing trading, again, the same type of thing, but I'll just reduce the 1 and 3. And like I say, a successful currency trader I know focuses solely on currencies, trades exclusively off the 240-minute and does very well out of it. All right, guys, whatever your time frame, keep your risk managed. Let me know the combination of time frames that you like to use in the comment section below. Always interested to hear your guys' thoughts on trading related topics. Take care. Bye bye.